Alright, analyst says XRP is getting ready to run, states what will trigger next big move. And that's coming from our news source Times tabloid. Today, digital asset market is dropping clues that we cannot simply afford to ignore. If you have been tracking the price action over the last few days, you know things have felt heavy. The atmosphere has been filled with questions, doubts, and a lot of noise. But right beneath that surface, a very specific structural setup is solidifying. A well-known analyst in the community, Levi Rietveld, recently went public on X to point out a major development on the daily chart. He posted that XRP has officially entered a closely watched high-stake technical zone. According to his latest update, we might be looking at the final stages of a major macro bottom. As a market observer, I have watched asset cycles reset time and time again. What fascinates me about this specific moment isn't just the fact that people are anxious, it's that the underlying structure is matching up with some of the most historic accumulation zones we've ever seen. So in this video, we are going to unpack exactly what Levi Rietveld spotted, detail the exact support and resistance boundaries currently dictates the market, and dive into why this specific alignment could completely alter the current trend. So let's get right into the facts. So let's start with why the long-term descending trend line, the most important line, here on our screen. To understand why this moment is drawing so much attention, we have to look at the primary barrier that has been keeping the market quiet. Ever since the massive high volume pump we witnessed earlier in January, the price has been restricted by a distinct downward sloping trend line, right? Every single attempt by the buyer to push higher has been met with heavy selling right at that exact line. This line creating a clean pattern of lower highs across the chart. But Levi Rietveld pointed out that the distance between this ascending ceiling and a horizontal floor is narrowing significantly. So in his post, he explicitly noted that a clean move above this trend line would break the multi-month pattern of lower highs and serve as the ultimate confirmation that the next big move is underway. He isn't throwing out random astronomical price targets. Instead, he is telling the market to focus strictly on this structural boundary. In my opinion, I am incredibly fond of patterns where an asset gets pinned down for months on end. It is like an elite runner pacing themselves behind the leader, saving energy for the final stretch. When an asset is constantly rejected by a trend line, retail traders lose patience and exit their positions. But history shows that the longer an asset is suppressed by a single line, the more violent and powerful the ultimate escape becomes once the market structure flips. So to me, this line isn't a sign of weakness. It is a sign of stored energy waiting for the right catalyst. All right? Now, have the buyers formally established a concrete floor at $1.10? Now let's shift our focus to the bottom of the chart, because a roof is only important if the floor beneath it actually holds. Following a sharp, aggressive decline at the very beginning of June, things were looking bleak. The asset actually dipped below the previous support level that managed to protect the market during the flash crash back in February. However, the daily chart shows a completely different story unfolding right now. As the price approached the $1.10 zone, a massive wave of buying liquidity entered the order books. The buyers aggressively defended this region, causing a clear rebound that has pushed the asset back up to its current trading price of around $1.16. In my opinion, this successful defense of $1.10 is a major win for the bulls, and it tells us a lot about who is controlling the market behind the scenes. When a flash decline happens, panic retail participants sell their positions because they assume the floor is going to collapse. But as a seasoned market observer, when I see aggressive buy orders stepping in at $1.10 to create a definitive daily bounce, it tells me that institutional accumulators and major whales are treating that specific price point as a high value zone. They are stepping in to build a fortress at $1.10, ensuring that the structural macro bottom stays completely intact. Right? Now, what happens to the market architecture if the downward resistance finally gives way? If the buyers can maintain this current momentum and successfully push the price above the descending trend line we just talked about, the entire landscape changes. According to the technical structure highlighted by Levi Rietveld, clearing the primary downtrend line leaves a relatively clear path ahead, with the next significant historical barriers appearing at the $1.60 and $1.70 ranges. These are the exact ranges or the exact areas where past trading volume created heavy distribution zones. So my view on this is very straightforward. Once the primary downtrend line right here is broken, a massive psychological shift takes place in the market. Traders who were sitting on the sidelines out of fear suddenly experience intense fear of missing out, or FOMO. They realize that the bottom is officially in, and they rush back to buy the breakout. This influx of retail capital, combined with short sellers getting forced out of their positions, creates an environment where resistance levels like $1.60 can be tested much faster than most people think possible. The transition from a quiet market to an aggressive rally happens in the blink of an eye. So, what critical key metrics should observers and traders track over the coming days? So as we move deeper into the month of June, the market is sitting directly in the middle of a high tension zone. We have an incredibly sturdy, well-defended support layer at $1.10, keeping us safe on the downside, and a stubborn long-term descending trend line right here, copying our upside potential at the top. The asset is essentially being funneled into a tighter corridor, meaning the time for sideways trading is rapidly drawing to a close. So in my opinion, if you want to stay ahead of the next major move, you need to ignore the day-to-day social media drama and watch two things. And these are the daily closing candles and trading volume. We need to see the price consistently close above the trend line right here on a high relative volume. If the volume is low during a move up, it could easily turn into a false breakout. But if the volume expands as we break past this trend line, that is a confirmation. Patience is the ultimate tool right now. The market is setting up its next major directional phase, and those who remain disciplined are going to be the ones positioned correctly. Right? Overall, to wrap everything all together, the data presented by Levi Rietveld right here paints a very clear picture of an asset that is rapidly running out of room to move sideways. The sharp rebound from the $1.10 support zone proves that there is immense buying interest underlying this market, while the long-term descending trend line remains the final boss that the bulls must defeat. As a market observer, my takeaway from this entire setup is that the structural foundation for a massive trend reversal is fully prepared. The market has successfully flushed out the weak positions. The major support levels have been rigorously tested and validated, and the asset is tightly wound within its technical boundaries. So when you look past the short-term noise and focus entirely on the architectural reality of the chart, it becomes clear that a structural breakout is brewing. So keep your eyes locked on that descending trend line and the crucial validation zones. Stay completely disciplined with your strategy and let the data guide you to your next move. And this finally ends our video. Thank you very much for watching, and see ya on the next one. Or you might just as well check this recommended video right here.